thank you very much for your time, first of all. Let's start with the profit level. It was better than the street had expected, partially due to cost cuts. Does that continue? I mean, is there still more fat to cut?
Well, we continue to work on our costs, yes. You probably saw that the headcount has started net to come down. That's a mixture of the work we did to restructure in Germany, which is now almost complete, but also we've been internalizing some of our technology people in particular. But the headcount's come down, so that will come through as reduced costs in future. And we continue to try to modernize the bank. So we distinguish between just running expenses and then investing, and we want to keep up the investment because we do need to move on with the modernization program. So a bit of a mixed picture, but we have been focusing on costs. Now we need to focus a bit more on the revenues.
You brought remuneration down to some extent. I mean, in the last couple of years, for example,
yes,
bonuses were cut.
Sure, we have.
Have you started to turn that around? Because surely, if you want to get the best talent, you've got to pay for it.
We have, yes. And in the detail of the numbers we've put out today, you'll see the variable compensation, the bonus accrual, has gone up a little bit, even though headcount's come down. So we're accruing to a bigger number this year. We only make the decision at the end of the year, so we don't know yet. But yes, we recognize that we've been a bit of an underpayer for a couple of years, and we need to rectify that.
Is that one of the reasons that fixed income trading revenue, equity trading revenue have not only been down, but also underperformed your peers in the U.S.?
Well, I'd argue against that in relation to fixed income. Actually, we're down about 12% on the trading side,
and your peers are
and
down
that's
16%.
That's in the pack. On equities, we've lost a bit of market share, and we're down quite a bit. And we think there are some underlying factors there. We do need to invest more in electronic trading. I think in the cash trading and derivatives is okay. In prime finance, we've seen balances come back, but they're not being worked on yet. So we've got more potential to make revenues from the prime finance, and those balances are back. So once activity levels pick up, we should see an improvement in revenues.
So how much market share do you expect to take? I mean, even if the whole pie is shrinking, you still want a bigger piece, right?
A little bit, although we never want to run the bank just chasing after market share ever again. The byword here is always long-term sustainable profitability. But obviously revenues are important, and we need to make sure we're relevant to our clients. So we need to invest in systems and invest in people. And we've been, particularly in our advisory side, but also in equity sales, for example, we've been trying to build up the numbers. That also works under the new MiFID II rules, which come in next year.
Where will you build up the numbers? I mean, where is your business, because of Brexit, obviously everyone's wondering, going to be focused-based?
Yeah, on the advisory side in corporate finance, we want to build out our industry sectors, and they're global. So a lot of the hires we've made in the second quarter have actually been in the US, because there's a lot of global expertise there in certain sectors. London will obviously be an important venue for us, but we'll also try to focus a little bit more on continental Europe and in particular Germany, where we've anyway been investing as we, to some extent, strengthen the roots of the bank here.
Is it only a little bit more? I mean, I get the idea that you're going to move, a fifth of the balance sheet out of London to Frankfurt, that you're going to be moving, what's the headcount, for example, that you're going to be moving from London to Frankfurt?
Well, on the balance sheet, I know this always sounds a bit complicated. It's actually already in Germany. There is this idea of a London branch, but the bookings are actually in Deutsche Bank AG itself, so we don't need to move balances. Whether we have an adjustment to where our people are depends really on what a Brexit looks like and what the rules are. What we've said is, from the perspective of contingency planning, we need to ensure that we can do in Germany in April 2019 pretty much everything that we can do in London today. And we know that means adding at least some operations people here in Germany. I'm not sure about moving, but certainly from the perspective of making sure the competences are the same, we do need to build here in Germany. So there is a positive impact here. We don't know what the impact will be in London. We genuinely don't.
But what would you guess your business is going to look like in London post-Brexit?
I guess that Eurozone clients will gravitate towards doing more business within the Eurozone, because going outside the European Union adds a modicum of risk. Just as they don't tend to book in our Tokyo branch or our New York branch today, it probably will gravitate to Europe, and we have to respond to the way clients react. but it's difficult to do anything other than put ourselves in a position where we can do that, because we really don't know.
Is it difficult? Is it more difficult to attract the best minds to work in Frankfurt? And I don't mean anything against Hessen.
No.
But if you've worked in London, New York, Hong Kong, you know, Frankfurt.
Certainly in many parts of investment banking, it's always been quite easy to move people from London to New York and New York to London, because they're the two main global hubs. It will be more difficult to move people here. It's not English speaking. New York and London have a lot of attractions which appeal to people in investment banking. And frankly, it's where the pipes are. It's actually where the infrastructure is. So I think it's going to be difficult. If all the banks in London are going to move somewhere else, it's actually not going to work for a while, because the infrastructure is there, like it or not.
Do you talk to local politicians or even national politicians about building that infrastructure up? Because even from the point of view of, say, schools, you know, or housing.
Here in Germany? Well, we haven't yet, no.
Let's talk about your revenue outlook. Mm-hmm. So you've said that revenue, I believe operational revenue at least, will be smaller this year than last year. Can you quantify that a little bit more precisely? Well,
if you take the first half as a whole, that's got to be a little bit indicative of the new footprint of the bank. Now, we've said in some areas we're not, you know, the revenues don't meet our expectations. There's good and bad. I think the macroeconomic environment in Europe is very positive. If you look forward, a lot of predictions now are for run rates of growth at the end of the year for the Eurozone of up to 3%. And that's way overtaken now the US. So we should be well positioned. We're very, very exposed to interest rates going up, very positively exposed. If they go up, we make a lot more money without any additional cost. And client activity levels genuinely were low across the sector. I mean, our American peers who've reported already said pretty much the same thing. So there's a lot of positive tailwind to that, but with the timing of those improvements is difficult to gauge.
How do you expect client activity to change?
Well, I personally would expect it to go up because our pipelines are looking good. Now, if you asked me that 6 months ago, in the US, we have very good pipelines. Unfortunately, to some extent, they're still pipelines. The possibility of a transaction's there, but it hasn't happened yet because there's been some disappointment in the development of the economy. At the moment, though, it looks positive.
Do you expect to start then taking more business? I mean, as your plan, as you execute on your plan, and as you also attract better people, rebuilding your trading group, do you expect to be able to take more market share in equities?
Well, equities, I think, is an investment story. We need to invest, I think, in technology. I'll be the first to admit we've let it slip a little bit while we've been doing other things in the bank. So there's a little bit of catch-up on technology.
This quarter, this half?
No, I think we need to do it over the next year or two, particularly in electronic trading. And then I think we need to invest more in people.
And you'll be doing that also in the next year or two? Or
No, we have been already.
Yes.
And in corporate finance, as I said, we've been building out some of our sector expertise. Again, that's a global story. Now, in the advisory area, our revenues, I think the number in the book is 91%. So it's almost doubled on the position last year. That's quite hit and miss. We happen to get a lot of deals completed in the second quarter. And the pipelines look okay. And there are areas where we've seen balances come back in our transaction bank, which we always think of as it's the backbone of the company. Our balances there are up 25% on last year. Unfortunately, they're in euros, so it's not adding anything to the profit line yet. But they're there. When client activity picks up, there's the possibility of leveraging that.
What do you expect to spur client activity to pick up again?
I think a little bit more certainty on the direction of interest rates. But there's a positive mental attitude in Europe because the PMI indicators are looking very strong right now, particularly in Germany, but throughout the Eurozone. And the France story has been a real pickup for the Eurozone.
But did you get a better sense of the direction of interest rates from Janet Yellen yesterday, or do you think from Mario Draghi we're going to get some sense of tapering? I mean,
well, there wasn't much from the Fed yesterday, was there? I mean, if anything, interest rate increases are now looking slightly less likely. In Europe, there's an interesting picture, which is that we're seeing the prospect of economic growth, but we're seeing absolutely no increase in inflation. So at the moment, interest rates are not moving because inflation's not moving. The central bank's not adjusting yet. Economic growth prospects are improving, so we've seen the euro go up in value versus the dollar. And the forex markets at the moment are taking the strain. The bond markets, the government bond markets, haven't changed very much yet. Though we've seen the yield on the Bund go up.
Globally, the inflation problem seems to be the same, right? Even if you get it everywhere else, you don't get it in wages.
That's correct, and that's as much a technology phenomenon, I think, which is a global phenomenon. But the macro picture is still very good, and interestingly, in the world, there are some difficult hotspots. There's still some geopolitical difficulties, but most of the emerging markets, the Eurozone and the US, are all showing reasonably good growth prospects.
On the profit side, I've noticed that your litigation costs have come down significantly in the last couple of quarters to almost nothing, and your loan loss provisions are down. Do you expect those lines to stay low?
Well, you're right. In the first half, our litigation number net isn't much at all. That belies the fact that there's some charges in there and then some releases of things where we may be over-reserved, but these things are incredibly difficult to guess at. On litigation, we have to fall back to the usual line. We don't really know. A net position of nearly nothing at all for the first half can't be an indicator of the future, frankly. So, no, we don't think that would continue.
And it can't, of course, fall below that.
Well, we could have net releases, but I don't think over a half-year period that would necessarily be the case. We've still got a provision of about $2.5 billion, so there's still some work to do, although we're very pleased with the number of settlements we've been able to accomplish in the first half. On loan loss provisions, it's a difficult one. Remember, we're very heavily exposed to Germany, and by and large, a very positive feature of Germany is people don't borrow very much, and when they do, they pay it back. So if you look at Deutsche Bank, over even the past 2 decades, we've generally been quite a good credit bank. Even in credit trading, we had a really good quarter. So if I looked at something we're really, really good at as a bank, it's credit, it's lending. And maybe the first half, the most recent quarter, was lower than normal, but we've never been a bank that's had a hallmark of very high credit loss provisions, partly because of this being anchored in Germany. Is it going to continue like that for a little while? But it's hard to say. We have one portfolio we keep a close eye on, which is our shipping portfolio, relatively small in the context of the bank. But credit loss provisions, last year we had our non-core unit, and that was a contributory factor. So the delta is not as clean as it should be. I would expect them maybe on a normalized basis to be a bit higher, but hopefully it's never a big driver of negative value at Deutsche Bank.
So your revenue outlook, you think it's going to be slightly lower this year, at least the operational revenue?
Well, remember, the second half of last year for us was not our happiest time. So if you're comparing it with the second half of last year, we'd hope for an improvement. Where it stands in relation to the first half this year is really difficult to say.
Now, what about on the profit side? I mean, it seems that what you're saying is everything's improving as far as margins and loan loss provisions, legal costs are going to stay where they are.
Yeah, I mean, overall revenues are down about 10-ish%, and costs are down 15% as a whole. But as you pointed out, loan loss provisions and the litigation line were a driving factor there. And also, remember restructuring. Now we do have some restructuring to come, which is announced, the Postbank merger. Difficult to gauge whether some of that's the end of this year, and some of it's obviously next year. We try to announce the details of that towards the end of the year. So the second half will be a little bit impacted by that, we would expect, sitting here today. Difficult to gauge. But otherwise, I think, with a bit of a tailwind on revenues and costs coming under control, our run rate is not very far away from our next year exit run rate. So we've probably accomplished a lot of the work we need to do on costs. We need to focus on revenues now.
All right. Thank you very much.
Thank you, man.